Good afternoon, everyone, and welcome back to another edition of Unlock the Stock, where today we're going to feature two repeat companies, and those are Attacq and Capital Appreciation. You know by now that Unlock the Stock is a platform specifically designed for retail investors to get to know corporate management and their businesses just a little better. Unlock the Stock is only possible with our technology partners, Lumi Global. You can visit their website at lumiglobal.com to learn more about their various integrated online AGM and presentation solutions. Our host today, as usual, will be the Finance Ghost and Mark Tobin of Coffee Microcaps, who will be facilitating the Q&A session in the respective breakout rooms. We would like to welcome back to Unlock the Stock, Jackie van Niekerk, the CEO of Attacq, and Raj Nana, the CFO of Attacq, as well as Bradley Sachs, the CEO of Capital Appreciation, who will take you through the presentation. In the breakout room, Bradley will be joined by Alan Solomon, the CFO, Michael Shapiro, the head of the software division, and Don Engelbrecht, the head of the payments division. So that should all settle out for some good conversation. Before we start, there are a few housekeeping notes. Each company will be given 12 minutes to present their company to you. You will see a button at the bottom of your screen under the More function where you can choose a breakout room to go to. That will be a 20-minute session. You're more than welcome to leave one room and jump across to the other room. Your questions can be posted by typing them into the chat function at the bottom of your screen, and Mark and the Finance Ghost will read those out, and that always helps with the discussion. As usual, this event is being recorded and will be available on our YouTube channel next week. We also want to let you know that we've started a LinkedIn page, Unlock the Stock, so you can have a look at that and follow it too. Once you are in the breakout rooms, there will be an email address that you will see on your screen. If you want to be added to the company's contact database, please jot down that email address so that you can reach out to the company. We are ready to start the session, and Attacq is going to start. So Jackie and Raj, I am ready for you to share your screen, please.
Good morning. Can you hear us properly?
We can hear you. We just can't see your presentation yet, but there we see it starting.
There we go. So let's give it
Great. Over to you, Jackie.
Thank you so much for the opportunity to present once again to Unlock the Stock. Thank you. What is Attacq? We're a real estate company, a REIT listed on the JSE Stock Exchange. Our focus is really a bit different to the other real estate companies, where we say we've got a precinct approach. So our properties are centered around precinct management. We've got 6 precincts scattered around South Africa, which the most notable precinct is the Waterfall City precinct in Gauteng. You'll see on number 4, the photo there. It's the beautiful skyline of our city, where Mall of Africa is our flagship asset, the Mall of Africa, a super regional shopping center. The reason we chose to focus on precinct is really almost a bit by luck, and then more a bit by design over the years, where we've really learned that we don't like uncontrollables, and the uncontrollables in the last 10 years of South Africa has really been the decay of the infrastructure and the municipality service supply. And we felt that if you control your surroundings and your environment, you can truly provide a sustainable, safe, secure, and a smart environment for your clients. So the uncontrollables become manageable with load shedding, water shedding, that we can really provide on a macro level the key critical supplies to our clients, which really is in essence that we're acting as municipality and then as a landlord to our clients. We've really seen that we've been able to pull multinational companies, and we continue to strive for providing that client-centric service that goes beyond just the real estate boundaries. If we look at our company and what we focus on, we see our business focus is very much focused on Waterfall City. That is our largest precinct. I'll talk a bit about how much bulk and land we still got to develop. Rest of South Africa is the 5 other precincts that is scattered around South Africa. And really, we've seen that in our real estate portfolio, despite the sluggish local economy, Attacq's defensive portfolio, and I would probably say one of the best portfolios in South Africa, with a diverse client mix, precinct dominance, and our proactive asset management keep on delivering great results, and that's really what we strive for. Our business diversification is a strategic arm of Attacq, whereby we still own assets in the rest of Africa. Currently, we're looking to liquidate that entire portfolio. Again, we like focusing on active asset management and not owning a majority stake in a particular business doesn't make sense for us, and hence the liquidation process. We also advance in our investments through PV investment, water projects, and digital transformation, especially in our meter reading side. As you measure, you get to know the data, and we become more proactive in the way we manage our business. Through our objectives in our business, you'll see there in the purple, long-term growth through a sound capital structure. We've really focused a lot over the last few years to make sure that the foundation of our capital structure is sound. Raj will go into the gearing, but we're one of the lowest gearing REITs post the GPF transaction we did last year. We also prioritize prudent capital allocation, and as that is the game that we're in as a management team, ensuring that the outcome of our capital allocation really works hard and provides our shareholders with a long-term sustainable business growth. We don't just look at a year one focus, but really at a long-term focus. The balance of our objectives is our people-centric approach, our staff, operational excellence through an integrated digital business, client focus. As I manage it's all about our lease and our clients and how can we provide an excellent service. And then very much is how is ESG woven even to our business. We make sure that the communities and surrounds that we operate in our environment, there's a positive impact, and our ethos at Attacq is leave a place in a better state than what we've received it. We go to the next slide. I want to ask Raj to take and give you an overview. Go.
Excellent. Thanks, Jackie. If you look at the right-hand side of the slide, geographically, we're predominantly based in Gauteng, with that being a large focus of that being Waterfall City, approximately 81% of Gauteng. And then Western Cape between George and Stellenbosch, comprising 12.5% portfolio, and then Mooienrivier Mall, which is based in Potchefstroom Northwest, contributing 6.8% of the geographical split. From a sectoral perspective, again, very well diversified, 42% of our portfolio, what really got to is collaboration hubs or offices, but 29% and then roughly 24% coming from logistics as well as retail, shopping centers and the like respectively. So a very well diversified portfolio. We've got roughly 5% comprising of hotels and data centers and the like. If you look to the left-hand side of the slide, it just graphs our financial performance from a distributable income perspective over the last 4 or so years. 2020 being the year that was impacted for the first time by COVID, 3 months of that financial year being impacted, and then 2021 bearing the brunt of COVID-19. You can see our earnings dropping significantly at that point in time. And then since 2021 up until this current financial year, which we are yet to report on, showing good growth, recovering and growing. The graph is that we've also changed our focus in a way in that other investments, which were largely comprising of mass as well as our other rest of Africa investments, has certainly featured less in our earnings as a result of a strategy of divesting from mass. And the last divestment took place earlier this financial year, FY24. And now 35% of our distributable income is roughly from rest of South Africa. So those are the regional shopping centers and other precincts in South Africa. And then 65% of our earnings coming directly from Waterfall City, which is obviously a well-diversified portfolio on its own. If you okay.
All right.
Yeah, I'm going to quickly just talk to the share price performance for the same period think about what COVID did to most companies and especially retail entities, there was a significantly negative impact on the share price during the course of COVID and then a slow recovery. But what you can see in the last 18 months, with the announcement of the AWIC GPF transaction, we had a significant jump in the share price. I think it was around 25 to 30% at the time. And then, more recently, over the last 6 months, we saw sector, and not just Attacq, but the sector showing signs of recovery. And I think on the back of maybe three distinct sort of pieces of information. One was the Fed signaling the rate cutting cycle, being imminently started, and that is obviously net positive for most industries, but more so for the real estate sector. And that saw a bit of a rally in real estate prices, and Attacq was part of that rally. And then around December, January, you saw one of the large pension funds in South Africa allocating a lot of capital towards real estate, and that then spurred a second rally. And then more recently, in the last 4 weeks, the announcement of the Government of National Unity saw a lot of volatility across sectors, but net, I think we're still trading slightly higher than the pre-announcement. And so I think a nice recent track record of growth in the sector and specifically around Attacq's share price.
Yeah. Our asset management focus, we really focus through our collaboration hubs. We want to be lead in the market. We want to manage and optimize a sustainable portfolio, focus and drive business efficiencies, but that's all words. We always like to show some case studies of how do we actually take these objectives and turn them into value. Our first case study is that at Waterfall Mall, we split a very large house and home box, but sell, unattractive, low turnover rental, but still a solid client at the mall. We through active asset management, we've split the space, we've introduced a new tenant, we've increased footfall, we've increased the rental income by significant rate per square meter, and then ultimately resulting in more revenue and lifting the asset value by 18 million rand. Another great example is the office market, which you also can say that with after COVID hybrid office and work from home, the office is dead. Well, certainly not in our portfolio. Yes, we do have clients exiting our portfolio or reducing in space. Every client works out what is our way of working. We've definitely see the hybrid working is here to stay, which results in smaller offices. At our Allendale building, illustrative, we went from a 2,000 to a 6,000 square meter vacancy. Our response is we've upgraded the common area. We introduced some great little features in the building, gave the building an upgrade. And as you can see, we've been actively letting the building, not just to any client, but to the likes of Eppendorf, Nokia. And we're currently busy working with the client that will take most of the space up, that will bring this building to fully let. So once again, through our objectives and our active asset management, we're able to bring our buildings to life and preserve the value of our buildings and our income. Waterfall City, developing Waterfall City, as you can see the beautiful picture there, a large component of land that we still need to develop. We've done certainly enough. And when we talk about why the city is great, I don't need to say more than just show you the international clientele of 65% of our Waterfall City clientele is international clients. All our clients really wanting to be in Waterfall and enjoy the safe and the smart and the sustainable spaces. So we're in really good company here in Waterfall.
And maybe just touching specifically around the developments and the development pipeline. If you look at the donuts on the bottom right of the slide, Waterfall City total bulk, starting bulk was around 3.5 million square meters of bulk. That's not an effective share, it's total. We work with a number of JV partners. If you look at the remaining bulk, just over 1.4 million square meters of bulk, a big portion of that, 46%, relating to logistics hubs. That's roughly 630,000 square meters of logistics bulk to roll out, of which our share is 50%, with our JV partner owning the other 50%. And I think we're really excited about this. We've developed most of our logistics land out in the last sort of 24 months. We've been activating this piece of land with the final town planning aspects. We're expecting that to be completed during the month of August. and then have the ability to roll out this piece of land in various phases. And the logistics sector itself has been fairly buoyant over the last 24, 36 months. Rental growth has been particularly strong. And so very excited about rolling out this. I think it's going to bode very well for Waterfall and Attacq, and going to drive growth in the near future.
Just another illustrative diagram of Waterfall, of our strategy of how we're rolling out the city. You can see that all the red is buildings that's completed. The blue and the yellow is either planned or under construction. And we're really moving of where we've allocated the capital. And we call it the lazy capital, and the infrastructure, the roads, the servicing of the land. This is the part that we've already serviced, and we'll continue to phase our servicing of our infrastructure and roll out the city out, to the eastern side. So really a great illustrative purpose of what we have done and what's up. This is only the city component. The logistics component Raj has spoken about is on the other side of the highway. And our focus now is completing the LIPS development, the Ingress development, and planning a great other residential development and another office development in the next few years to come.
I think we're almost out of time, so we're going to literally just
last slide.
Let's chat to this in a few seconds. June 2023, we were 37% geared, 8.3 billion rands worth of debt. Post the GPF transaction closing, we reduced that to just under 5.8 billion. And our last reported gearing at December was around 25%. So like Jackie said, we're one of the lowly geared REITs out there with the significant pipelines. I think we're well primed to roll out that pipeline. And another exciting project that we're working on is establishing our GMTN program. We've done a lot of work on that, and we're expecting to come to the market with an issuance around October of this year. And that could mean, margin compression of somewhere between 25 and 35 basis points. So another opportunity to reduce our overall cost of debt. Thank you.
Thank you so much. It's felt like speed dating.
Thank you, Jackie and Raj, for that presentation. Before I hand over to Brad, I'm just going to ask you guys if you could maybe try and sort out the audio from your room, because it's coming and going. So if you can put yourselves on mute and then just try and sort that out when we go into the breakout rooms, please. Brad, thank you very much. Over to you.
Thanks, everybody, and thanks for hosting us again. I'd like to welcome many of you who are shareholders of ours already, and for those of you who aren't, please feel free to join the party. So the presentation that I have up is a relatively lengthy one, which I am not going to go through in detail, but will let you know that it will be posted on our website for anybody who would like to go and download, as is the presentation that we gave for our recently released results for our fiscal year ended March 31, 2024. As a group, we have grown to over 1 billion rand of revenue over the short 5 or 7 years since we have made our first acquisition. Within our payments division, we have approximately 500 million rand of revenue. In our software division, we have approximately 600 million rand of revenue. We are about 750 people within the organization, and we are quite proud about what we have built over a short period of time. Our investment case, I think, is pretty easy to understand. We are playing in a sector that has strong growth characteristics, not only in terms of the organic elements of the strategy, but also in terms of acquisition opportunities, which we have done quite a few. The market opportunity is large for us, both domestically in South Africa and in international markets, and we continue to grow our share in that market. We have been able to solidify ourselves as a true partner of choice amongst blue chip clients across all the industries in which we have elected to participate. We did start primarily as a company focused on the financial services sector, but as our expertise has become evident, we have expanded into other industrial verticals as well. The team is exceptionally talented, very well skilled, and we have an enormous amount of dedication and enthusiasm with respect to what we are doing. Our track record through the accolades, which we will show you shortly, demonstrates that we do have real leadership capabilities in this area, and we are not only focused on the here and now, but we have invested into the future of the business as well. And we continue to do that, not only in our people, but in technologies and in new products and in innovation. And I think that's what stands us ahead of many of our competitors with respect to organic growth opportunities. Our businesses are highly cash generative. We have a large cash pile on our balance sheet, which we have available for acquisition, share buybacks, investment in the business, and we are going to continue to invest that money in ways that we believe to be value additive. And you can see at the bottom, it's about 460 odd million rand. So in terms of the overall economy, we are a derivative of the economy. There is no business that is isolated, although I think we have been able to demonstrate an element of resilience given the nature of the sector in which we have operated. Our revenue for the group for the year was up 19%. We have seen acceleration in the demand for certain of our products, although we have seen an elongation in the sales cycle on some of our software and development initiatives. We have been able to diversify our revenue streams away from what were the more dependent, the ones that were more dependent on terminal sales. We have invested a tremendous amount into the future of the business. This is money that we generate from operations. So you can see the cash characteristics of our business. Our estate in terms of terminals was up 9%. Our annuity revenue was up 28%. Payments revenue was up 31%, although some of that was a result of the acquisition of Dariel. Our cash from operations was up 75%, and we successfully integrated the acquisition of Dariel, which was a transaction that has been with us now for just over a year. Overall, we were successful on a number of tenders, which I'll get to, so we have a good business pipeline, although we still continue to see delays in the initiation of certain projects that we had experienced previously. We declared a dividend which took our dividends per share up to 10 cents for the full year. Our headline earnings were up 83%, and our dividends were up 21%. So overall, even in a very sluggish economy, our businesses have done very well. I am not going to spend too much time on the financials. I'd rather spend a little bit of time talking about the business and explaining the business. Our presentation on the results is available on our website. In terms of the payments business, our estate has grown to 357,000 devices in the hands of clients. Our annuity revenue on the payment side was up 28%. Our EBITDA margins were up 500 basis points at 44%. And if you look at the bottom right-hand quadrant, you will see the composition of our revenue from payments. And so it's a very diversified set of revenue streams, which gives us a very balanced business, which allows us to operate both in good times and in less good times, which is what we have just been through. So overall, we are pleased with the performance of payments. In software, our revenue was up again 32%. Our license and subscription fees were up 20%. The consultancy fees were up 44%. But we have seen and we have experienced some delays in many of the projects that we were working on. That has resulted in us being over-resourced, and we incurred incremental costs beyond what the revenue justified, and so our margins have come down. It is something that we are continuing to witness, but we are hopeful that with some stability in the country, we will find the larger institutions willing to again spend on innovation projects. And so we are working hard and diligently to make those resources productive. I wanted to give you a sense of how our payments business has evolved. When we acquired the company, it had one client. We expanded into multiple businesses and multiple clients and expanded the nature of the services that we offered. And we are now positioned to go beyond 2024 with a full range of services with a high emphasis and focus on software related to payments, not only on the software for terminals, but in multi-lane environments and other areas. What really is important for us is that we have a growth strategy that's coherent both in payments and in software. And I think that if you look across this list of items that we've identified as growth initiatives, we have been able to execute against all of them over the course of the last year. And so I will go through some of those with you now. We were able to bring on 2 new bank clients. One of them is African Bank, and the second is the Nedbank terminal estate, which was previously supplied by the company today called Lusaka. We were successful in 2 material tenders. The one was with Absa and the other was with Nedbank. I have, since our results, become alive to the fact that both of those institutions have disclosed the size of their estates in their own public documentation. Absa's estate is 132,000 devices, and the Nedbank estate is approximately 100,000 devices. And so that is great new opportunity for us within our business. We have worked very hard on securing those relationships. We were successful in the fuel sector. We have spent enormous amount of time on reinvigorating our software efforts in payments, and that has yielded a number of results for us. I am going to talk quickly about the terminals. We have supplied those in the past on a sale basis. A number of our banks have started to ask for a rental relationship. We are doing that. We are funding that out of our own cash flow resources. And those are 3 to 5 year contracts, which are very lucrative for us as an organization. We have expanded into the large retail outlets. That adds an opportunity to us of about 100,000 odd devices. We had our first deployment in conjunction with FNB in the Clicks retail chain, and we would be looking to be competitive in other initiatives when retailers come back to market. We have a partnership with ACI Worldwide, which is a huge provider of financial software solutions, and we are in the final stages of certifying capabilities, which they will take to market for us globally, on which we will generate license fees. So a really good initiative for us that was previously not part of our portfolio. Some more innovation that you can look through on your own. We continue to be very focused on our Halo product, and you will see a number of those things come to market. One of the areas of growth is in the refreshing of estates because of legacies, spectrum issues in the telecom sector, the degradation of the 2 and 3G networks, and that has been delayed through to December 27, but that is going to drive demand for new terminal sales. Layup is an investment that we made. The business is doing nicely. Continue to follow it on LinkedIn, and you'll see the success that it is having. On the software side, we have a very coherent growth strategy as well. We have some meaningful relationships with organizations like Confluent, AWS, and Google Cloud Platforms, which is GCP, and including Azure. We are partnering with Microsoft as well. So we are going to continue to leverage those partnerships. Our objective is to grow license revenue, which is on proprietary technology that we develop. We have a very measured expansion into international markets against a South African cost base, which gives us a competitive advantage. And we are continuing to invest in new emerging technologies, which has been the lifeblood of our software division's success, whether it was early adoption of cloud, early adoption of generative AI. It is an area where we are continuing to innovate. AI is very important for us, and I will talk about that shortly. And we have some overcapacity, as we spoke about, and we are using those resources to continue to invest in some R&D. In terms of recognition, the software division has received recognition for its excellence from a number of independent parties, and we are very proud of the work that the teams in the software division have done. The one that I'm going to call out is we were voted the preferred software development company for large business projects in 2024 in a survey that was conducted by My Broadband. And the competition that we had was stiff, so a really good accolade for our team. We have great credentials, which is what leads to our successes. And with the acquisition of both Daryl and Responsive, we have a much more comprehensive software offering, which is Synthesis, Responsive, and Daryl combined, which has over 500 software engineers focused on delivering solutions for our clients, primarily in the financial services sector, but we have expanded into retail, into healthcare, into telecommunications, into logistics. So one of the areas I am going to also do by way of case study is look at what we did around the use of AI for a telematics partner, where they were having issues around the costs associated with and their ability to handle data that they were getting, data points that they were getting from the fleet that they managed. We were able to reduce the extent of their costs by, the extent of the data points which related to real emergencies by a material amount, close to 90%, allowed them to focus on issues which were of extreme urgency that resulted in an ability to handle customers' calls much more efficiently, reduce cost, and led to a material increase in customer satisfaction. We deployed our Halo Dot solution into Howler. As some of you may know, Howler is an event ticketing business. When you go to an event and you need to pay for drinks or snacks or other memorabilia, they had a set of devices that did not accept payment. We implemented the Halo Dot solution on those devices for a very cost-effective solution to them. We have provided a health case study that Daryl did a deployment for Life Healthcare. It was a comprehensive engineering of their systems. It demonstrates the breadth of our capabilities across different industries, not only in the financial services sector. We have in my team.
I'm very sorry to interrupt you. Would you mind wrapping up the rest when we're in the breakout room so that we can give everyone an opportunity to ask you questions?
This is exactly where I was going to end.
Okay,
So,
sorry.
I was going to say, we have a minority investment in asset pool. You can find more about that on our website. So thank you very much for your time, and I will speak to you in the breakout session.
Great, Brad, thank you so much. To everyone that's on the call, if you click on the More button and find a breakout room you want to choose, I am going to hand you over to Mark, and the finance ghost will be in the respective rooms. Thanks very much.
Yeah, I think let's start because obviously we want to get as much in as we can in the time that we have. So to the Attacq team, thank you for returning to Unlock the Stock. It's always lovely to have you guys on. We'll see if the internet holds up. Hopefully it's a breakout room, not a break-up room. And we'll see. We're just going to have to see. It wasn't too bad. It was just here and there. It was mildly hilarious because it was specifically when you were talking about how everyone wants to be in Waterfall and then the internet broke. But,
and I think it's the same with a smart city.
yes, exactly. So yeah, I mean, you can't make this stuff up. You can't script this stuff. It's just how it happens. But we'll do our best, obviously.
If you don't mind, to save some bandwidth, and we've got our teams working at the back. If you don't mind us switching our camera off, I really would like the quality of the answers.
I think it's fine.
Go.
I think that's fine. I have no problem with that. So to the attendees who have chosen this room, thank you. You're in the Attacq room. If that's not the one you wanted to be in, now is your chance to switch. Please send your questions through to me as a direct message here in the chat, and then I can ask them to the team. So I'm going to just kick us off then with a nice sort of high level question, and it's something just for my own interest as well. I've been writing quite a bit about the property sector in the last few weeks. I'm quite bullish on what the next year could look like for the REITs in general. So that's going to be pretty interesting to see that play out. So first, just starting with a high level question from my side. So you've obviously got this government of national unity resurgence, this upswing in sentiment. That's all very lovely. Maybe some improvements specifically in Gauteng. I think everyone knows the Western Cape has been a relative winner of the past few years versus Gauteng. Which is where we've been from a governance perspective. What does the government of national unity mean in terms of Gauteng for you? And I'm guessing you must be feeling quite good about just the Waterfall district as a whole and how you've positioned it over the years. So maybe let's start there with just some views.
So maybe I'm going to give a bit of more practical views, and also maybe you're going to talk on the financial views. So yeah, I think Ramaphosa did the right thing for the country, and you certainly feel it in the hope of people, directly what's translated, not just a bit of a share price rally, but we've seen increase in sales in our residential units. So people said, the last 2 months before the government elections, they buying units again. We're seeing much more people through the mall, and we're also seeing that leases are converting, into actual signing of leases. But that's just the anecdotal day-to-day management things, where we've positioned Waterfall, and I very much focus on the precinct, and we almost playing the municipality. What we've experienced over the last 10 years is the incredible delay of getting approvals through the town planning, the poor governance in the, in the government of the lack of service supply. And if that starts moving into the right direction, we are so well positioned, from a Waterfall point of view, to execute even faster than what we are currently executing at this stage. Then I look at, the amount of investment we see with the multinationals investing into Waterfall, and the will for them to invest even more. Again, coming into a country where there is a little bit of more positivity from a growth point of view. Gauteng remains the economic hub for South Africa, and we see that the multinationals need to open up their offices here. They need to operate within Gauteng, and we see how our multinationals are scared of spending too much money establishing offices, establishing their people here. They've had great they had great trouble of bringing international people working and residing in South Africa with the poor systems we had from international getting your visas. So we're really hopeful for those small practical wins, better governance structure so that the processes and decision making can go faster so that we can execute faster and better. We have got the systems, we've got the people, we've got phenomenal land. And then if you've got small ones from government, oh, it's a really great time for us to be Attacq and develop here in Waterfall. Raj, I don't know from a financial point of view, interest rates.
Yeah, I think you've covered most of it, Jackie, from a government of national unity perspective. I think that the biggest thing that we've seen, and Jackie did touch on it, was the renewed optimism from corporates in general, and their ability to make long-term decisions. Because signing a 5 or 10-year lease, whether it's a logistics warehouse or an office, etc., is a long-term and a big commitment. And we've seen that turnaround times are much quicker. Guys that have been on the fence and are now coming to market in RFPs, etc. And like you say, as sort of one of the leading nodes and precincts in Gauteng, we're going to be the net beneficiary of that. And we've seen definitely on the logistics side a long list of inquiries, and definitely also on the office space. Yeah. Although requirements have maybe shrunk, there's certainly an increased number of inquiries coming through on the office side as well. Yeah.
So I'm getting a good couple of comments on Twitter/X around the Falcon and whether or not that is still going to happen. I must be honest, I had to Google it. It's like a space shuttle or something that Musk would be building. A new skyscraper proposed for Midrand's Waterfall City. I found an article from 2018. Is the Falcon ever going to grace our skies?
It will eventually, but we say capital allocation is our game. The Falcon will grace the skies if it makes financially sense for Attacq to develop it. But we might have a baby Falcon gracing the skies in the next few years. We will be launching actually a site next to the Falcon site, a residential scheme, very similar with the same developers that we've partnered with at Ellipse, which is a phenomenal success for us. So it's a smaller scheme. It will be, Raj, 18 stories.
Yeah,
18 stories Falcon. I think we've just got over 30 stories. So let's call it baby Falcon. Will grace the skies of Joburg in the next 24 months. We hope to start sales 1st of September. Again, we've had phenomenal success of Ellipse, and we're learning from that development, improving, and it's next to the Falcon site. So for us in Attacq, we will develop where it absolutely makes sense from a financial point of view, and then also from a long-term sustainability point of view. We've worked incredibly hard to bring our balance sheet in a state where it is at the moment. We're really well positioned to unlock these opportunities as long as it makes financially sense from a capital allocation.
Yeah, small and exciting. You're going to have to call it the Hummingbird or something new and just go with that theme.
Yeah, I might consider we still don't have a name for it.
There we go. You can use it for free. You can just send me a thanks. No, I'm kidding. I definitely wouldn't use my property naming ideas. What I do want to understand on the residential side is, is your intention always to develop for sale? Or are you planning to hand on to any units for rentals over time? Or is it to develop the building, bank the profits, and rather hold on the sort of commercial side for rental?
Yeah. So it's an interesting thing because we've applied our minds with regards to the residential strategy. I think what's important for us is to roll out residential developments from a city perspective. For the city to work with the various type of assets that we bring online, you need an element of residents to keep the city alive at night, bring feed to the mall, etc., etc. So residential developments is critical to the rollout of the city, and like Jackie said, in the next couple of months, we're pretty excited about our next high-rise development. But from a REIT perspective, holding on to a dozen or 2 dozen units is relatively small for us. Doesn't really move the needle. It is a specialist type of business managing, short-term. When I mean short-term, it's usually up to 12 months as a maximum tenor. And certainly our expertise lies with managing precincts as a whole, but definitely focusing on larger corporates and creating value from that perspective. So there are rental pools that have been created within Ellipse. We're certainly not participating in it, but there are various investors that have created these pools, and my understanding is that they're doing relatively well. But from an Attacq perspective, too small and not a focus for us.
Yeah, and I found it interesting that one of your learnings from the recent development was to actually drop down from bigger units into more smaller units, and that improved the saleability of it. So maybe that just talks to the precinct, I guess. It's kind of that young, upwardly mobile as opposed to looking for lots of space with kids. I mean, that's the challenge with residential. You've got to really think about the demographic of people and where they are in their stage of life that you're attracting to that area. And that's part of what makes it tricky.
Yeah, and maybe also we also take into account the bigger node that we operate within. You know, we don't see ourselves as this island. So we take into account the estates that's also been part of the Waterfall development, which has been a phenomenal success, the cluster unit development. So we really do our research far and wide to see what's in the area and where is the need in the area. You know, and our land is also much more expensive than, you know, we need to go vertical up. And we like the young, upcoming, vibey person that's going to shop in the mall, that's going to, you know, use all of the facilities that we've got all around, and all the, you know, the youngsters, you know, spending their time at the mall. So we really do our research far and wide to make sure that we offer a product that will work, not just for us to develop. You know, we're not developers that building a building and walking away to another site somewhere else. We own and operate this precinct. That's ours. So we need to make sure that it's got long legs and a lot of sustainability.
But like personally, I've always enjoyed the focus in your business. I think that's a big part of the investment case. I mean, and you've gone and now bought the remaining 20% in Mall of Africa, if I'm not mistaken. So something I wanted to ask was, you know, does that give you any more kind of operational flexibility? Is it purely an economic decision? You just like the price with Atterbury? Or is it that you now have the ability to actually go and do more than before?
It's a bietjie van alles.
Yeah, it's a bit of everything. I think for the longest time, our team has been managing the asset. And so from an overall asset management perspective, not much has changed. But the fact is that you no longer have a sort of minority owner sitting alongside you, questioning your strategy, having a slightly potentially different view on the asset and how to grow the asset. So that makes it a little bit more streamlined and a bit more effective. And I think the mall team is really happy that, you know, they can probably move quicker with decisions and implementation. But I think the real factor for us was, we certainly believe Mall of Africa, you know, will go through cycles, but it's got a lot of legs in terms of growth. As we identify the city, the mall is going to be the net beneficiary of that. And we're investing a huge amount of capital in and around the city with, you know, office developments, logistics developments, infrastructure upgrades, residential upgrades. And you've got then a minority owner of the mall, which is just focused on the mall, getting the sort of, you know, the upside of all of the investments that we're doing, which was a big consideration for us. But what also, you know, going forward, you know, Jackie mentioned the residential development that we want to kick off in the next couple of months. That sits right on the mall side. It joins the mall. You know, we're looking at potentially in the next, you know, in the short to medium term, a potential, you know, hotel, maybe a conference facility, and all of these are adjoining to the mall. And again, we're adding to the value of the city. The mall's going to become the net beneficiary. Why not own 100% and capture all of this value as we go forward? And it obviously helps that we bought it at, I think, a great price.
Yeah, it makes a lot of sense. When I advise private companies and they're thinking of getting a minority shareholder in, I always use the analogy. It's like getting a tenant in your spare room. They'll never just stay in their spare room. At some point, they're going to irritate you in the TV with the TV remote, you know, and it's going to be a problem. So I think that makes a lot of sense. I want to move on to active asset management. So there's Pick and Pay, obviously, which gave, I won't say their name, but one of the funds in the market, such as Scrick last year, or earlier this year, that they decided not to pay anyone a dividend, much to my irritation. Moving on from that, you mentioned Pick and Pay, and it seems like you maybe have some really good stores in your portfolio. There's no space that they want to give back to you, but I just want to actually take that question broader in terms of asset management and actively managing the space. How does it work in practice? Do you go to a tenant and say, listen, your trading density isn't where it should be. We have a better use for the space. Would you like to give some back? Or do you wait for them to come to you? Or is it a bietjie van alles?
Ek weet 'n bietjie van alles. You know, it's a very dynamic space, and I think that's why I love this industry that we're in so much. Again, we love looking at data. You know, your trading densities, you know, provide you a lot. We also look at our clientele and how they move around the stores. So when we start seeing, I'm going to give you a great example. I love putting case studies. So it was a few years ago at Mall of Africa. We called in 8 months before they started that horrific process that we started going through with them, you know, wanting to pay less rentals, closing some of the stores, and then when they went into that business rescue. So 8 or 12 months before they actually started that process, we called them in and said, guys, We want to bring in a pick and pay at the bottom section. Can we take back that space? Firstly, you're not trading optimally. We do not like the amount of stock and the way you're presenting the stock in your stores. What's going on with Edgar's, because we are not liking what we're seeing from a face value and the data that we are receiving. So we did that deal way in advance. Then when Edgar's went into business rescue, similarly, we closed the Edgar's at Eikersstad Mall actually a year before that, and we replaced it with an H&M. So we try and train our asset managers to be in tune with looking at the data, looking at the trend, but also making sure that we beat the street. And what I mean about that is that we go into the stores, we see what they do and how they operate. And then a third component to that is we go on retailer roadshows where we ask them, how are you doing? What's the business looking like? And all of those data points very clearly direct the asset managers is, yes, problems coming, or, you know, there's no problems coming. We don't even need to pick up the financials of Edgar's to know there's a problem. Some of our clients do not want to be proactive. They'll say, wait for the lease expiry to come up. So, you know, so that's where the Bikkie van Alles comes into play. It's how willing a client is also to work with us and come up with a great solution. And I mean, I commend someone like a House and Home that was willing with us to say, let's cut our space into half, bring another, actually competitor next to us, but net beneficiary, there'll be more feet coming past our store. We've got a smaller space, our cash flow is better, we can carry the same amount of stock, and we can have a higher trading density. And that's what we encourage through our asset management practices with all of our clients.
Yeah, brilliant. Thank you. That's very interesting. I want to ask you about the back to work trend and what that means for the office space, or I think collaboration hubs, as you guys call it.
Yeah.
What are you seeing in your office portfolio around back to work? I mean, I've been watching this quite carefully, speaking to as many people as I can, and it seems like you know, most people are back in the office. So what are you seeing on your side? And obviously people being back in the office is great for office property owners like yourselves.
Yeah. You know, I'll call it, I said there was 3 phases we went through. We went through the uncertainty phase, that was COVID, and we all discovered Teams and Zooms is a great thing since last cheese. So, wow, we can run our businesses off of these, you know, digital platforms. I think, and then when life became back to normal and we could take off our masks and go back to the office, people were in this, you know, uncertainty phase of what's each business going to be? You know, are we going to be a full-time back at the office? We certainly called our staff as soon as possible, everyone back to the office. We're a real estate business. We need to be in office. But we've seen every business grappling with this. What are we? How are we going to work? And what we are starting to see crystallizing almost 2 years post the pandemic is certain companies are 100% back. There's companies that said, you know what, we like the hybrid thing. It works for us, but we need an office space. And I think that is the most stickiest model that we are seeing transpiring out at the moment, is people saying, I need an office space. I need a great collaborative space for our people to come, ideate, strategize, connect with each other. We can't do that over Teams. We have to need physical space for that. But we're also allowing our teams the flexibility to work a day or two at home. And for that reason, we might need less space than what we needed in the future. Here in Waterfall, we're seeing clients spending phenomenal amount of money in their fit outs and really looking for that employee value proposition to say, if you're coming back 2 or 3 days a week to the office, we really want to make it cool and effective for you to operate from the office. So my personal prediction is hybrid office is here to stay, but the office will remain the key center point for most of the companies.
I 100% agree with that view for what it's worth. Obviously, you guys have a better view of it than me, but that seems right. I wanted to ask you about logistics as well. So, and we've only got a couple of minutes left, but this is an important one. Obviously, logistics was really the winner of the pandemic above all other properties. And if I look internationally, if I look locally, there's still this nice trend towards, you know, e-commerce, and that means more distribution space, maybe a little bit less storefront. Just commentary from your side. I know you're developing those MIDI units as well. What do you see as the broader trend and opportunity there, you know, that's driving the logistics portfolio?
I mean, the MIDI units are relatively small. They're 4,500 to 5,000. So they attract a different type of user, and we've got a number of inquiries. I think we've let one, and we've got an inquiry on the remaining 2. The market certainly seems buoyant, and you're 100% right. I think it's got to do with logistics. we're seeing a lot of third-party logistics players coming out in the market looking for large boxes, sometimes on short notice. So they're shortlisted on RFPs for retailers looking to outsource some of their logistics. And they're looking, to acquire, big boxes from 20 to 80,000 square meter boxes. And we've seen that as certainly a catalyst in the last, the last sort of 12 to 18 months for sure. And I think that the aspect that we're also seeing is sort of still cold storage inquiries coming through. And the nice part about logistics is, there's been a lot of technological upgrades in terms of racking and how picking is done, etc. So some of the older boxes that was constructed a number of years ago are no longer appropriate for these third-party logistics players, and so they're looking for new boxes that can cater for this. And once they stick in their own equipment and their own tech, it does become a little bit sticky for them to leave afterwards. So certainly thinking that the trend will continue. And like I said, very excited about what Waterfall Junction means for us in catering for that particular market.
And all of this is a good reminder for me of why I don't like residential buy-to-let and residential letting businesses, as opposed to all the stuff you can do around logistics, retail, offices, that asset management opportunity. It really does come through very strongly. We've probably got time for one more question. We'll squeeze in two if we can, but I want to get to the balance sheet. This DMTN program that you're looking at doing, what are the benefits of that in terms of your funding mix and also your cost of debt over?
Yeah, so I mean, fortunately, we've been historically very well banked, if I can call it, between a number of the big five banks as well as institutional providers of debt capital. So we've never had a situation where we needed to tap new sources of funding. And more recently, post the GPF transaction, our debt number has actually shrunk quite a bit, and we've got significant lines still available with most of our existing relationships. So really, the DMTN program is for us a means to reduce our overall cost of capital. And what we've seen more recently in the last 3 months, our peers coming to market, tapping their programs for between 500 and 1 billion rands worth of new money. The spreads are really, really tight. You can pick up 3-year money somewhere between 125 and 130, 5-year money around 135, 140. And so really an opportunity for us to reduce our own overall cost of debt by somewhere between 25 and 35 basis points. We're obviously aiming at the latter. We don't see the debt capital markets becoming our sole source of funding. It'll probably be a maximum of about 25% of our overall debt requirements. So we can probably get to, at current levels, about 1.5 billion. But obviously, as the balance sheet grows, as we develop more, we'll use that as an important source of funding, but together with our bank funding.
Yeah, it makes a world of sense. So I see the breakout room is going to close in 40 seconds. So I'll just close by saying, my bull case for the sector going forward is definitely, well, there's a bunch of reasons for it, but one of which is going to be what will hopefully happen to the cost of borrowing over the next couple of years. And hopefully the headroom you'll have on loan to value, not just Attacq, but the whole sector, if valuations can increase because valuation yields are a bit less under pressure. I think there are good reasons to believe in the property sector at the moment. So I just wanted to say thank you for your time on Unlock the Stock and for coming and speaking to this retail investor audience. We obviously love it when companies support this platform, and you guys have supported it more than once. So thank you very much.
Thank you for your support. Thank you.
We'll see everyone back in the main room to wrap up shortly.
Hi, everyone. We're just going to wait for Brad and the rest of the capital appreciation team to come across here. And then we'll get going with the Q&A session. I'm just trying to see, have they joined us yet? Not as yet. I see Michael is here. And here's Brad. Brad, hi.
Yeah. Hi, Mark. How are you?
Hi, Mark.
Good. And I see Michael Shapiro is also here. I'll give it one more second while we're just waiting for Alan and the rest of the team to come across. Just upfront disclosure from myself. I am a capital appreciation shareholder, so I just want to put that out there in the interest of transparency. Brad, maybe I'll kick off with the first question, and maybe we'll start where you finished, asset pool, and maybe we can talk about layup as they're kind of similar investments. Can you give us an update on, where these companies are in their life cycle? Are they profitable, not profitable, on the way there? And kind of what's the long-term thinking from capital appreciation? Are you happy to be a minority shareholder, or is there a formula that can be followed through time where, these become wholly owned subsidiaries or folded into the wider group, whether that's in the payment division or in the software division?
So these are more off-the-run investments that we made for a variety of different reasons. They are minority investments, which is not what we are focused on. We are much more focused on control investments, and we will not make too many more of these. In the instance of layup was made because it is a capability to add onto our terminals and a solution that many of the retailers and our bank customers were looking for, related to financing of activities at a point of sale. We do not provide financing. We are a balance sheet light organization. We are not interested in taking material credit risk on those types of things. But this was a technology-based solution that would assist retailers in dealing with their consumer customers. So it was a way for us to experiment in that area. And the business has done very nicely. It's behind where we had anticipated being when we first made the investment, because one or two contracts that they thought they were going to secure did not evolve on that timetable. But you will see that the business has made great strides with Pick n Pay. The business is growing exceptionally fast now, and we are very pleased with where it is. Layup, asset pool, on the other hand, is an area where we have great capabilities for cloud initiatives, for using AI, for doing data analysis, and we think it is an area of material growth and is an area where we can add value. So those are two sort of circumstance-specific investments that we made.
And I see a question in my DMs here just on layup, and maybe just touch on increasing stakes, selling off stakes, maybe just to touch on kind of the long-term thinking there.
I think each will depend on the state of the business and other alternatives that present themselves for the business. We are not committed to control those businesses. If there are opportunities for transactions, we will explore them, but it will be dependent on the state of the business at the time.
Okay. Another question in my DMs here on the ABSA Nedbank tenders. You've got 395,000 or 350.
365.
59. 365. Okay, there we go. Terminals in the estate. So somebody's saying here, well, if you add Nedbank and ABSA into that, it's like a 60% increase in the terminal estate. So maybe just talk about what winning those two tenders from Nedbank and ABSA actually means, as the kind of contract and relationship rolls out over the next 1 to 3 years, let's say, because I know a lot of these, they don't all turn over on day one. They have a kind of a shelf life in terms of hardware.
Right. So we expect these to be long-term contracts. It's not a one-off event that occurs. It's a bit of a journey. And so we expect to be able to increase our estate over the course of the next 3 years by, let's say, approximately 50%. Because some of the terminals will be replacements, some of the terminals will be new. We may not do all of them within that time frame, but our mindset is we'd look to grow our estate by about 50% over the next 3 years.
Okay, and that will be through the Nedbank and ABSA ones. And in terms of how those are going to be deployed, are they going to be all on the rental model with ABSA and Nedbank, or is it purely down to their end customer deciding, no, we're going to buy them through ABSA or buy them through Nedbank, or we're going to kind of rent them?
So our relationships are with the banks, not with the retailer themselves. So the determination as to whether or not to purchase or to rent the terminals is made by the bank. The relationship and tender with ABSA was for rentals, and so they will look to rent the terminals from us and then enter into whatever relationship they want to with the retailer. The Nedbank tender was for sales, so we would look to sell the terminals to them. In each instance, we continue to provide estate management services. So there is annuity revenue that comes with those rental or sale transactions. So we will see an increase in our estate management fees. We license software to them for payment software. So we will see an increase in our annuity revenue through those contracts. And so we think that they will have a marked impact on our payments division over the course of the next 3 years.
Yeah. And Brad, I don't know if you want to comment on this one, or maybe Michael can take the lead on it. But the question here on, the software business, obviously, great looking revenue chart, but the EBITDA chart is not as attractive. The question is it purely an issue of, clients cutting back on costs, and, then obviously you guys have an oversupply of resources, or is it, something that can be, resolved internally, where you shift resources from one client or to another division or more into R&D? Maybe just, Michael, talk on the software side.
Yeah, thanks, Mark. So yeah, we're very proud of the revenue growth that we achieved for the year. It does include the new acquisition of the Dariel business that has integrated very nicely into our group. Bearing in mind also the revenue mix of our business has changed over the years, and we've spoken about it in previous presentations. We do have an additional contribution from hardware sales or the resale of third-party licenses that does come at a much lower EBITDA contribution due to the margins that we receive from that versus our software business activity in general. But we do have, due to probably two factors, the macroeconomic conditions that are affecting our South African customers, and also a supply of technical resources in the global market, has put some pressure on our customers to commence with these projects, or alternatively to use internal resources to deliver on them. So we certainly have seen some sort of degrade of our margins in that current year. And we, as Brad has mentioned, we're using this internal resource to develop proprietary software projects or proprietary software that will develop into product, which in time will enhance our margin capability. So we are placing those resources on the projects where we have firm commitments from our customers. Our strategy is very strong. We're working with our partners who have actually provided us with significant work. The AWS partnership and the newly formed Google partnership are showing significant promise. So we're redeploying those resources appropriately to ensure that we return to our standard level of EBITDA contributions. But it takes some time to do that. That certainly doesn't happen overnight.
Indeed, and we had a PBT group on here last week, and they were pretty much singing from the same hymn sheet. So it's more an industry-wide. They're also bemoaning the fact the cost of talent, globally especially in the tech space, is a scarce resource, which is putting pressure on margins across the industry. Let me just check if I got anything else in my DMs here quickly before I maybe pull one of my own. Okay.
Mark, just on that topic, I would confirm that it is an industry-wide phenomenon that we are seeing it not only in South Africa but in international markets as well, that there is this delay given some of the dislocations that are happening across the world. There have been many companies that have had material layoffs as a result of it, and we've taken the affirmative decision not to do that because of the scarcity of resources in South Africa, and make sure we continue to position ourselves for the turnaround, which we hope will come with the stability in the government.
We've seen some good announcements coming out today. I just noticed on Twitter before we started. Brad, or maybe one for Alan, since he's joined us now. The GovChat change in the kind of expected loss there. I mean, that drive last year and this year has driven kind of a big disparity between EPS and HEPS, and it does get a bit confusing. But maybe just Brad, or maybe Alan, give us an update on where the whole GovChat process is at now, and why it has led to this kind of large revision of kind of what the expected losses is kind of going to be.
So I'll deal with that. Where we are with respect to GovChat is we have exited business rescue. We went into business rescue to deal with our capital structure. We and our partner in GovChat have agreed that all expenses going forward will be borne equally between us and them. The business itself of GovChat has been shut down. We found dealing with the public sector and government to be very difficult, and something we as an organization are not necessarily equipped to do. So we have no ongoing operating expenses for GovChat. The only thing which remains is our claim against Meta with respect to damages. There is a suit currently in front of the Competition Tribunal, where the Competition Commission, which is an arm of the South African government, is prosecuting Meta for unfair market practices effectively. And we have been able to join that case as a party, and that is probably going to be heard by the tribunal sometime next year. Once that determination is made, we will then start our litigation against Meta for damages. So the only expenses we're going to incur are legal related, but there are no operational expenses. The expected credit loss was with respect to monies that we had previously advanced GovChat, and there are limited further advances except for these legal expenses. So that's where we are as it relates to GovChat. And we expect any expected credit loss provision to be materially less going forward.
Okay. And I guess the GovChat proprietary knowledge and software and learnings that, because you did run a couple of big campaigns during COVID, I think was it for the Department of Social Development, if I remember correctly. Is there any interested party who is more, what shall I say, familiar with kind of dealing with, government departments who might be interested in acquiring it? Or I guess what's happening to the IP that's left in GovChat?
We still have the IP that's available. If there are interested parties who would like it, they are welcome to approach us. We went through a process to see if there were parties, and nothing materialized. So we still have the IP available to us, but we are not going to incur any more costs in trying to work with government. There was a separation between us, or between GovChat and Eldred Jordan, who was the founder of GovChat. He has moved on, and so we have effectively put a lid on all of those activities.
Just a question on the cash flow, because it was particularly strong over the year. Was this a timing issue from a prior period? You know, it fell out last year and came into this year, or is it just kind of indicative of you know, better collections and just those changing product mixes, meaning that, you know, there isn't such a lag between revenue cash flow? Not that there was ever really a large lag in capital appreciation's case, but has the mix changed that it's actually now kind of more improving the cash flow, and you're going from more instead of a negative working cash flow to a positive working cash flow? Because if I take Michael's business, you know, the hardware and software licenses, I presume they be paid for upfront on an annual basis, and then you just kind of amortize the costs, so you get the cash up front, but you only deliver the service over the next 12 months.
Alan, do you want to deal with
Yeah.
that?
Yeah, I think there's no doubt about that. The businesses that we have throughout the group are not only asset light, but are very strong cash generators. The cash flow that we generated, particularly in the 2024 financial year of 320 million rand, was exceptional. But that was a direct reflection of excellent asset management. The level of our receivables was collected quicker, notwithstanding the fact that they were previously also well collected, but we reduced in our receivables, and also we had a reduction in our inventory. But it has an element of cut-off, but fundamentally the effective asset management, which has been characteristic of the group since we acquired these businesses in 2017, on the one hand, effective expense management, and also, of course, we generated higher operating profits, and they manifested themselves readily into from EBITDA and profit before tax into after tax cash flows. There is quite a significant amount of numbers in our income statement that are non-cash flow related, i.e. the amortization of intangibles, depreciation, and the like. But fundamentally, that highlights the low risk nature of the businesses because of the blue chip type clients that we deal with, and we are very good at matching our inflows and our outflows from our trading activity.
Brad, just another one. I want to touch on one thing that's kind of happened post the results was the announcement of the 3.6% share buyback. Maybe just a comment on that, just given, you know, capital appreciation isn't the most liquid stock in the world, with, you know, the PIC being the largest shareholder. I think they're, what is it, 25% they're up to now?
25%.
And, you know, yeah, how did that, you know, come? Was it, you know, one large institution who came and offered you a line, or was it just you saw kind of where the share price was, and with the cash that sits on capital appreciation's balance sheet, decided to take the opportunity?
So we went into the closed period having pre-approved a buyback plan with the JSE. And so we have bought these all back through the market. We haven't bought them back from any individual institution through a line. We continue to believe that our share price does not reflect the underlying value of the business, but I leave that for everybody to make their own judgment. But as a management team, we think it's a good use of capital for us to take some of the excess cash that we have and repurchase shares. It accrues to the benefit of all shareholders. It is accretive to our business overall. We measure the amount of cash that we want to spend on that against opportunities that we have to invest it elsewhere. We're also cognizant of the limited liquidity that we have, so we've got to always balance the desire to buy the shares against the opportunity of others to buy the shares. But that was the reason for the increase.
Okay. And then just a question more broadly then on capital allocation. You know, buybacks are an opportunity. Dividends, you know, up again, and I think it says in the slide that you presented, it's like the 7th straight year, only 3 more years and you'll be in the dividend aristocrat one. I think it's 10 consecutive years. what, should people be thinking of a certain payout ratio, dividend cover, if we look at the results backs over those few years, is there kind of a set policy or a kind of guideline that the board likes to stick to when it comes to considering dividends on an annual basis?
It's often a robust debate at the board when we get to the results period as to what type of dividend we should be paying. We have no set policy. We look at the opportunity set. We look at how much cash we generated over the period. We look at what the short-term cash needs are and what we think the cash generation of the business will be in the future period. And then we make a determination. So we can't take all the surprise out of it, Mark. It's not going to be mechanical. But we recognize that dividends are a good way to reward shareholders. We also recognize that we have other demands for the cash. And so we will make a determination at the end of each financial period as to what we think makes sense in the circumstance.
Okay, Brad, we're going to have to leave it there. So I just encourage everyone to move back to the main plenary room, and Vanessa will wrap up first and give us an update on what we've got upcoming on Unlock the Stock.
So thank you to everyone who participated in Unlock the Stock today, and a special thank you to Jackie, Raj, Brad, and the rest of the team from Capital Appreciation for the time you took today to support this platform and to engage with the investors. We hope that you've enjoyed the event, and if you want to listen to it again, it will be on our Unlock the Stock YouTube channel next week. Please join us for next week's session, which is going to take place on the 18th of July, and this is a special session on the local REIT market in South Africa. It will include everything that you need to know about investing in this particular market and the benefits of the asset class. It is supported by the South African REIT Association and will feature Keelan Ndlovu in conversation with the finance ghost and Mark Tobin. So until next week, same time, thank you very much for joining us today, and goodbye.